This 5-minute trading strategy that you are about to learn is simple, easy, and it works every day. If you have subscribed to our channel and have been following our updates for long now, you see how we make complex trading strategies very simple that even beginner traders can easily understand and apply it to their chart and make money for themselves. If you follow this strategy that you are about to learn step by step, as we'll teach you to the last part, you'll be able to repeat very good results on your trading account. Follow carefully, as the last part is the most important. But before we get into all of that, do well to like this video to help other traders also become profitable, and subscribe to our channel if you are encountering us for the first time. Now my tribe soldiers, let's get down into this business. In this strategy, we are going to be placing our focus on zones. In case you don't know what a market zone means or what it looks like, here is a brief explanation to guide you. The zones are those areas in the market where the market has a high chance of making great trading moves. If they come across it, these zones have the ability of making the market prices rise significantly or fall significantly. There are many examples of zones, and traders call them many names. We have the supply and demand, support and resistance, order blocks and liquidity. All these are called zones. The supply and demand occurs when the market made a significant price move from a certain price point on the chart. So as traders, we expect the market to return to that point, and when it returns, we expect it to move even much higher than the first significant move. The support and resistance occurs when there is a current price structure where the market price is reacting to a certain zone in the market and making great price moves from there consistently. So as predictable traders that we always expect the price to rise or fall massively when they touch any of these zones. So when they touch the support zone, we expect the market to rise, and when they touch the resistance zones, we expect the market to fall from there, which may not happen in all cases. Now, the order blocks and liquidity are the advanced strategies of the supply and demand zones. These strategies work with the zones of supply and demand, but a little twist in their concepts, like the candlesticks and their structures. But anyways, they still work with the supply and demand zones. By the time I start showing you the examples of this strategy at work on the chart, you will see why these zones are very important. With the help of these zones, you will be able to know exactly where the market will be moving to next. But knowing the zones are not enough, because the zones have one common enemy: the stop hunts. This is the common enemy of every trader trading the zones. A few days ago, I was about to break my personal trading record to make $650,000 in a single trade. With the tight risk of $147,000, I took the trade, and for the moment everything was going good. The analysis was sharp, and I was waiting for the market to start making those big moves towards my take profit target. My stop loss was very tight, and my take profit target very wide, just according to my strategy. The market started making some price moves, and then came the stop hunt. It took away my very tight stop loss, moved some tiny pips down below my stop loss, and started moving towards my take profit target. At last, the trade was able to hit my take profit target level, but without me. It's crazy. The stop hunt is inevitable for any trader, and it's responsible for at least 30% of most losing trades. But with this strategy, we are going to be able to avoid at least 80% of the stop hunts and be able to hit our take profit targets, even without being on the chart and monitoring it. Now, how does this strategy work? First of all, we need a double top or a double bottom structure. It can be in an uptrend or a downtrend. The overall trend does not matter. All you need is the structure, a structure like this. And before you proceed with this structure, you have to make sure that this part of it is already moving towards a direction. And when you have seen something like this, you draw a box from the high to the low of the double top or the double bottom. In this case, it is a double bottom. When you have drawn the box like this, you have crossed out to zones. The market can decide to break out from the top and it can also break out at the bottom, but you are in control. If the market breaks out from the bottom, we are no longer going to trade the setup, but if it keeps moving and breaks out from the top, then we can proceed to the next step, which is to wait for a strong retracement to the box. When I say a strong retracement to the box, I mean something evident like this one. When you are trading this setup, you don't want to see a little retracement to the box, as that will only be a fake out, a trap to lure you in a trade. You want to see a big retracement like this one, and when you have seen this, you are 80% into taking a good trade. Now you would need a strong entry candle to validate your entry, and without this correct entry candle, you still stand a risk of a possible stop hunt. It is this entry candle that will determine if you are going to make it in a trade or not, and our entry candle for this is the two main trading candles used by profitable traders, and they're called the pin bar and the engulfing candle respectively. The first is a single candle and the second is a pattern. Their structures are different, but very easy to identify. For the pin bar, if you are trading it, you must make sure that the pin bar appeared as a target candle. What this means is that the pin bar must appear according to the color of the direction that you want to go. So if you want to go bullish, you need to see a bullish pin bar in a bullish color, and if you are targeting a bearish trade, you will need to have the pin bar to appear as a bearish pin bar with a bearish color. That is easy to understand. The engulfing pattern is self-explanatory. All you need is to see a candle engulfing the last previous candle. In a bullish setup, you need to see a bearish candle engulfed by a bullish candle, and in a bearish setup, you need to see a bullish candle engulfed by a bearish candle. Now, after you have seen any of this entry candlestick pattern, all you have to do is to place your stop loss below it, and you take profit target at the next high or low, depending on the setup. And if there is no high close enough, you place your take profit target at least 3 times the size of your stop loss. I'll show you guys some live examples on the chart, but before we get to that, let me quickly introduce you to our mentorship program. Tradingtrybe has an ongoing mentorship program, a 2-month course to turn you from a losing trader to a profitable trader. And you are not only going to be learning my personal advanced trading strategy that I use to make thousands of dollars in the market daily. You will also be getting up to 1 to 3 daily VIP trading signals and analysis on major currency pairs and derivative synthetic indices from the same strategy that you'll be learning in the course. Both the mentorship program and trade signals last for 2 months. To get access to our mentorship program, click the first link in the description box below. Now, let's get to the examples. So first off, we need a double top or a double bottom to appear on the chart, with one target area already trying to break out. And right here, you can see that we have just that. So we wait for a clear breakout, and here we have it. See how this breakout is very evident and not small. This is the kind of breakout that you always want to see. This is the type that brings you profits. So now, you wait for the retracement of the breakout. And when that has happened, you allow the market to create a target entry candle. And here you can see that we have a bullish engulfing candles, which is our target entry candle. So from here we can take our trade, placing our stop loss below the engulfing candlestick and our take profit target at the next high. And as you can see here, our trade was successful. Now let me show you another example of this on the chart. This will be a bearish example of the setup. Here you can see that we have a double top. And when you have seen the double top, you should wait till you see a little bit of price movement to the downside, which is the target direction. And when that has happened, you draw a box on it from the high to the low of the double top, and then you wait for a breakout. And as you can see here, this breakout was very evident and clear, so it's valid. Next, we wait for the retracement to the box, and when that has happened, we wait to see an entry candle. In this case, you can see a bearish engulfing candle, which is exactly what we need, and from there we can take the trade, placing our stop loss above the engulfing candle and our take profit target at the next low. And as you can see, We got the perfect trade. Our take profit target was hit successfully. This strategy is very simple, and if you can take your time to practice it, you will see great results in your trading, helping you to get ahead of other traders and at the same time avoiding a lot of stop hunts. And if you love this video, wait until you see this simple 5 minutes moving average trading strategy. Here, you'll learn a simple but yet highly profitable moving average trading strategy that works like magic. This strategy is not only powerful, but it also gives you low risk trades with high returns on your trades. See you there, my tribe soldiers.